Welcome to Wealth Coffee Chats, folks, for your daily live updates. Get the most out of today's episode by participating in the chat. Make sure you ask some questions, be part of the conversation, have a bit of fun, grab a coffee or a tea, take some notes, and get ready to start your day, folks. Quick few housekeeping rules, though. No spamming, no advertising or self-promotion in the chat. That's not on. Be kind and respectful to everyone when participating. And most of all, have a good time. Real estate investing can be your biggest asset. It also can be your most expensive asset when it comes to getting it right or getting it wrong, folks. It can be time-consuming, stressful, and that's why here at Positive, we have what's called a 6-star team, a full-service team that provides integrated wealth and property investing solutions and services simply designed to help you progress towards your goal of passive income through your property portfolio, folks. Make sure you check out our other podcasts on the Positive Mentor Network. Not only is there Wealth Coffee Chats, there's the Urban Property Investor. Drops every Wednesday with straight talking investing strategies and lessons with Sam Saggers. Property Investor Tales. This is where our clients, you guys, share real life stories from property investing, hosted by some of our advisors and strategists. And that's done every fortnight, dropping every Monday. Wealth, Wine and Wisdom, folks, that debriefs the week that was in the world of finance and property, hosted by yours truly, Jason Witten and Andy Fenton on Fridays. Hey, good morning, folks.
Good morning, everybody. Welcome to another Wealth Coffee Chat.
Hope you're well, folks, wherever you are.
There it is, team. Morning. Morning, wherever you're tuning in from today.
Early bird gets the worm, they say. Here at Positive, we offer a 6-star team. It's a team that help you at every stage of your wealth creation journey.
Good morning, everyone. Welcome to Wealth Coffee Chats. I'm your host, Sarah Shome, one of the senior mortgage and finance brokers here at Positive Money. This morning, we'll be talking about your home loan and a quiet, nerdy little rule that could change the entire Australian mortgage on its head. The problem is that for decades, the big four banks have held a secret financial superpower, and that is an invisible competitive edge that's allowed them to operate more cheaply than smaller lenders. It's what's allowed them to be dominant and, quite frankly, sometimes slow to offer you the best rate. This week, the banking referee APRA announced that they will be simplifying the path for smaller banks to get this exact superpower. The battle lines have now been redrawn. So what is this? I'm hoping to explain this banking jargon in simple terms and tell you exactly what it means for your next refinance and why your mortgage broker is about to get a whole lot more options. Let's start with the basics. Every bank has to keep a safety cushion, and that is cash in reserves. It's to protect you and the Australian financial banking system. This cushion is called capital. The size of that cushion is determined by RWA. Now, everything in the banks is a 3-letter acronym, so I'm going to try and explain them the best I can. But RWA stands for risk-weighted assets. The RWA is an insurance premium. Think of the bank's loans as an inventory of cars. The risk-weighted assets is the cost of insuring that inventory. A high-risk loan, for example, a unsecured business loan, is a high risk-weighted asset, and it requires a big capital cushion. A low-risk loan, for example, a owner-occupied mortgage, has a low risk weighted asset, and therefore it requires a small cushion. For the lenders, there are two calculators when it comes to determining the risk weighted asset, which is the problem. The calculator number one is the standardized approach, and this applies to the small banks. They are using a small conservative formula, and they must assign a high safe risk weight to almost everything. They are forced to hold more in capital than is necessary for their best loans. But calculator number 2 is the IRB approach, and that stands for the internal risk-based approach. This applies to the big banks. This is their superpower, for lack of a better word. The large banks have invested billions to build internal systems, a precision supercomputer that models loan risk using decades of their own historical data. They can prove to the regulator that their high-quality Australian mortgages are statistically safer than the generic formula says, which allows them to run their own internal numbers and ultimately tie up less money. This gives them the competitive gap. Because the big four get to use their precision calculator, then they tie up less money and safety cushions, which lowers their cost of doing business compared to small banks using the generic calculator. And that gap is their profit advantage. So what is the precision in that supercomputer? It's not just checking your job title. There's modeling in 3 specific risks for every loan. When I was an assessor, I had to weigh up 3 risk ingredients. Number 1 is PD, which stands for probability of default. This is what is the chance that you will default within the next 12 months. For a solid, reliable mortgage, banks calculate this is as incredibly low. It's usually less than 0.5%. It's never 0, but it is tiny. The second point, or the second ingredient, would be LGD, which is loss given default. If you do default, how much money will we actually lose? Because a mortgage is secured by a house, the bank expects to get most of the money back. The actual loss rate is usually quite low, say roughly 10 to 20% of the loan balance. That brings us into risk ingredient number 3, and that is EAD, which stands for exposure at default. How much is the total loan balance at the time of default? So, for example, what is the total loan balance plus accrued interest, legal costs, repossession costs, etc. The key to the advantage is the internal risk-based banks can prove their probability of default and loss given default are low, especially on mortgages. This allows them to assign a much lower risk rate to your loan, requiring them to hold less capital. The smaller banks, though, are using a generic formula. It cannot reflect this low risk, so therefore their loan is effectively more expensive to them. So let's bring this back to what this means for you and your wallet. What does APRA making the internal risk-based path easier mean for the average borrower? Firstly, it means the end of the cost gap. This change is designed to give smaller, hungrier lenders the financial ammunition they need to compete. When banks operate more at the same low cost base, can't talk today, gonna get it out, as the big four, they have to compete more aggressively on price. This results in downward pressure on interest rates across the entire market, especially for refinancers. It also means more specialised deals. If a credit union gets an IRB approval, they can prove that their specific customer base is safer than the national average. They can then offer market-leading, high-tailored rates to those low-risk customers. So those may be people with low LVRs or certain professions, forcing the majors to scramble to keep up. And we all know with the majors that trying to make changes with them is like trying to turn the QE2. It's very slow to happen. Lastly, it means that better credit access for small businesses. The standardized approach is very conservative, particularly with business loans. The internal risk-based approach allows for more accurate risk assessment, which means mid-sized banks can offer more flexible and cheaper business credit, and that will support economic growth. This is a quiet regulation. that is actually a massive competitive shift. It is APRA trying to force the market to be fairer and more efficient. Don't expect the change tomorrow, though. Banks need to spend time and money to get this accreditation. We will see the full mortgage wars benefits unfold over the next couple of years. But the smart borrower knows competition is coming. Use this knowledge when you're talking to your bank or your broker and ask them, how will the lower cost of capital from this APRA change be reflected in my rate today? Be proactive, because the advantage is starting to shift. So that is it for this week's Wealth Coffee Chat. I am Sarah Shome. Thank you so much for joining me. You'll be back with Kang next week, and I shall see you all shortly. Thank you.
Another episode of Wealth Coffee Chat, folks. Make sure you like, subscribe, and turn on your notifications so you never miss a thing when we go live. Improve your portfolio and investing game, folks, with Wealth Coffee Chats live every morning at 8:10 each weekday. Make sure you join us. Previous episodes are also available wherever you get your podcasts, folks, as well as our other podcasts from the 6-Star team here at positivementor.com.au.